Hi, this is Kriti and welcome to Corporate Lens. Today I will be breaking down Japanese yen carry trade. What is it, why it matters, and what is happening right now. Japanese yen carry trade is a strategy where investors borrow Japanese yen at very low interest rates and invest in countries or assets that offer higher yields. Japan for decades has kept almost zero or even negative interest rates that has made the yen cheap funding currency. So the global investors think, why not borrow in yen cheaply and invest somewhere that pays me much more? How does yen carry trade works? Investors borrow yen at very low interest rates, sometimes like 0.1%. Investors convert yen into dollars, euros, rupees, etc., and invest in higher yield assets such as US Treasury bonds at paying 4%, Indian government bonds paying 7%, stocks, and emerging market assets. So the profit is basically the higher return minus yen borrowing cost. Why does a yen carry trade matter? When investors do this at a scale, the yen becomes weaker because investors are selling yen to buy other currencies. Global assets, especially in emerging markets, get big inflows because of fresh money is moving into the markets. But when the trade unwinds, things can happen sharply. The markets can crash. If the yen suddenly strengthens, the investors rushes to exit. And this can trigger stock market sell-offs, currency volatility in emerging markets, and a sharper appreciation of the yen. What causes a carry trade to unwind? If Bank of Japan raises interest rates, borrowing yen becomes expensive. If global markets become risky, then investors pull out of higher yield assets. And if Japanese institutions repatriate money, this means Japanese banks, insurers, and pension funds, they would want their overseas investments back home. They sell the foreign assets, convert those dollars, euros, and rupees into yen, and bring the yen back to Japan. Now, all of this makes the yen strengthen and shakes the global markets. So, what is in the news right now? Yields on Japanese government bonds have climbed across short and long term maturities. The 10-year Japanese government bond yields have risen to around 1.94 to 1.95%, marking its highest level since 2007. The 2-year Japanese government bond yield has hit around 1.01%, a 17-year high. And the longer term bonds like 20-year and 30-year have also seen yields surge. So the yields once pinned, near zero for decades are now moving up sharply across the curve. The Bank of Japan has dropped its ultra loose monetary policy. Bond yields are rising and the yen is strengthening. As a result, borrowing is no longer almost free, which means that the carry trade is losing its edge. So, what does this recent hike in yields mean globally? The investors are unwinding carry trade positions. They are selling US stocks, crypto, and bonds and converting back to yen. This triggers sell offs and liquidity tightening. Now, risk assets get hit, and emerging markets and cryptos all feel the squeeze. And the yen becomes the center of the global financial conversation once again. If you found this video helpful, do share, like, and subscribe for more such insights. And thanks for watching.